Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in Russia, and specifically to talk about the shock decision that the Bank of Russia has just announced that it's cut interest rates to 15.5%. And the reason why this is a shock is because interest rates are predominantly used to manage what's going on with inflation. That's what the central bank does. It's independent from the government, so it's not following political ideology. It's looking to keep the economy in check, and inflation is seen as being a key metric. And we have a look at what's been happening with inflation in Russia since the war in Ukraine started. You can see that it's been a persistent problem. Immediately following the invasion of Ukraine, inflation rose to above 16%. That is a very high level. And if you look at what's been happening over the past 4 years, you can see that inflation on average has been running somewhere between 8 and 10%. And that's compared with the Bank of Russia's target rate of 4%. Now, you might be asking, why has the Bank of Russia got a target rate of 4% when the USA, the UK, and the West have 2% as their target rate? Because Russia is an advanced economy, it's not an emerging economy. And that's a very good question because it should really be at 2%. But realistically, Russia is nowhere near getting to 4%, never mind to 2%. So if we have a look at what's been happening with inflation over the past 12 months, the latest results have just been released for January, and they show that inflation has risen in January. If you look at what's happened between March and December, you can see that inflation came down from 10.3%. Double digits for an advanced economy is really quite worrying. But it managed to get it down to 5.6%. However, as you can see in January, it's now increased again to 6%. So if you were an economist, if you were sitting in the Bank of Russia and you're looking at what happened in January, then you would probably say, I don't think we should be cutting rates. Let's wait and see what happens with inflation because it started going back up again. And when inflation goes up, then the central bank should really be considering increasing interest rates because when you reduce interest rates, as they have just done, what that does is make borrowing cheaper, and therefore it encourages companies and individuals to take on more debt. And when you take on debt, you're given a big chunk of cash by the bank. You then go and spend that cash on something. That's why you take the debt on, because you've got a pressing desire to do something. And when you spend that cash, it increases the flow of cash in the economy and therefore increases demand, and therefore will probably lead to an increase in prices. So reducing interest rates tends to cause inflation. Increasing interest rates tends to have the opposite effect. It makes borrowing more expensive, therefore people are less likely to do it, therefore reduces spending and probably brings prices back in check. And this chart shows what's been happening with interest rates in Russia over the past 5 years. You can see that there was a big jump in interest rates immediately following the invasion of Ukraine to 20%. They then came back down very rapidly, probably more rapidly than anybody expected them to 7.5%, which interestingly was less than the rate had been before the war started. Didn't really make much sense. We then saw another increase in interest rates between the middle of 23 and the start of 25, and they got up to 21%. That is extremely high. That is very prohibitive if you're thinking about borrowing money. But over the last 9 months, we have seen interest rate reductions to the current level of 15.5%. So those interest rate reductions sort of tell us that inflation is now under control. But unfortunately, that isn't what the people of Russia are saying. If we have a look at this chart, it shows the expectations in Russia of interest rates going forward. And the current expectation is 13.7%. Now, that is a long way away from the official inflation rate of 6%. It's more than double. And these inflation expectations are taken from surveys within Russia of households. So this is what people in Russia think is happening with prices. So what that tells us is that there's a disconnect at the moment between what people are experiencing in terms of their spending power and what's happening with prices of things that they're buying and what the official rate of inflation in Russia is telling us. And if we widen the scale of this chart to show what's been happening over the past 5 years, the current expectations for inflation are some of the highest that have been seen at any time in the past 5 years. And if we look at 2025 and the start of 2026, you can see that the expectation has been consistently above 12%. So this is telling us that there is a definite disconnect between those official figures of 6% and what's happening on the streets in Russia. So based on where we are with regards to inflation, the cut in interest rates doesn't really make sense. And just before we go on any further today, could I ask anybody that hasn't subscribed yet to please hit that subscribe button? Really helps me with the algorithm. And also wanted to remind you, I'm currently running my competition whereby you can win either my property or a cash alternative prize. So have a look at the QR code on the screen now if you'd like to support the channel in that way. Now let's have a look at what's been happening with the value of the ruble, because this is a topic that lots of people love to talk to me about. I hear constantly that the value of the ruble is very strong at the moment. Therefore, that means that Russia is doing very well. If we have a look at what's happened with the exchange rate, this shows the exchange rate between the US dollar and the Russian ruble over the past 12 months. You can see that the ruble has strengthened quite significantly. 12 months ago, one US dollar was trading for around 93 Russian rubles. Today, it's trading for around 77. So that represents quite a significant increase in the value of the ruble. So does that mean that the Russian economy is doing well? Well, President Putin recently announced that GDP for 2025 had come in at a very disappointing 1% growth. And that compared to 4.1% that was seen in 2024 and 2023. So we've seen GDP growth crashing compared to where it was in the previous 2 years. So that's telling us that the economy isn't doing that well. And the reason for that is because the wartime economy has now run out of steam. Russia has been sponsoring all of these companies to make things for the war effort in Ukraine. That's been boosting the performance of all of those companies. It's been providing wages to all of those staff. We've seen lots of big increases in wages because there's a lot of competition. All those state-sponsored companies have been recruiting people from all of the commercial ventures. But unfortunately, the war economy has now run out of steam because, firstly, the Russian economy is struggling to pay for it because it's got a huge deficit. And secondly, you can't go on just funding yourself forever. At some point, the merry-go-round has to stop, and that's what's happening. Now, the valuation of the ruble is quite relevant to what's happening with all companies in Russia, particularly those that are exporting goods. So the oil and gas businesses and coal and all of the raw materials that Russia has a lot of. Because the problem that you have when your currency is strong is that you always have to convert all of your earnings back into rubles when you're reporting them in Russia. So all of those companies that are exporting, they're not being paid in rubles because nobody wants to deal in rubles apart from Russia. So they're getting paid in Chinese yuan, US dollars, euros, whatever the other party wants to pay them in. And then that company has to switch it back into rubles. But when the ruble is strong, that means that you're switching it back into a smaller number. So all of the companies that are exporting, and they're basically the biggest companies in Russia, are currently reporting reduced results because the ruble is really strong. And so it's depressing the amount of revenue that they're showing in rubles. Therefore, it's depressing their profits. It's therefore depressing the amount of tax that they're paying. That's one of the reasons why GDP is currently growing so slowly in Russia. So the strong ruble is actually having a negative impact on the Russian economy. And one of the things that's linked to the value of your currency is what's happening with interest rates. So in theory, the fact that Russia has very high interest rates at the moment should support a strong currency, because if you think about it as an international investor, you're looking for the best return on your capital. So countries that have high interest rates usually are more attractive because if you put your money into that economy and it's growing at 15.5%, which is where interest rates are at the moment, then that's going to give you a pretty healthy return. Now, Russia is slightly unusual because it's not really operating as an open market right now. This currency is actually being managed deliberately by the central bank because they're being told by the Kremlin to keep the currency strong. So President Putin was very unhappy when it was trading at 100 to 1 US dollar, and so it's now down at 77. He's feeling more happy, but actually it's having some really negative consequences on the Russian economy. So I think one of the reasons why the Russian central bank is happy to reduce rates, firstly, is because of the slowdown in GDP growth. And so cutting rates does make it more attractive to borrow money and therefore potentially could boost the economy. And also, cutting rates should have a negative impact on the value of your currency. Well, it should have, but when you're managing it, it doesn't really have the same impact. Now, if we have a look at the latest expectations by the Bank of Russia, they have now revised their forecasts for 2026 and 2027. This tells us that things are not going well in Russia at the moment. So the previous forecast for 2026 inflation was that the bank thought that it would be coming in somewhere between 4 and 5%, which is at the upper end of where it wanted to be. The target rate is 4%. The revised forecast that the Bank of Russia has just issued has increased that forecast to 4.5 to 5.5%. So they're acknowledging that it's unlikely, well, it's basically impossible, that inflation is going to come down to the target rate of 4%. Previously, they were hoping there was a chance of getting it down to that level. I don't think it's likely that they'll get down to 4.5 to 5.5%, given what's happening right now. But this is the latest revision. So they've acknowledged that it's impossible to get to the target rate in 2026. They're still saying in 2027 they'll be at 4%, which I think is probably ambitious from where they are right now. If you look at GDP, there's no change in the forecast. It's forecast to be somewhere between 0.5 and 1.5%. That compares to the 1% for 2025. So the Russian economy will continue to grow at a very slow rate in 2026. It's probably more likely to be towards the 0.5% of that range. And in terms of where they think rates will be, well, previously they were saying somewhere between 13 and 15%. They're now saying 13.5 to 14.5. So they've increased the bottom end and they've reduced the top end. Now it's currently sitting at 15.5. Obviously, it's within the bank's control to set interest rates, but those rates are still extremely high. And one really telling factor here is what's going on with oil prices. So in the original budget that was put forward by the Kremlin, the average oil price was assumed to be $59 per barrel for Russian oil. And that's important because Russia's biggest export is oil, and the average price that you're selling those barrels for is obviously really key to making sure that you hit your revenue targets. Now, in the previous forecast, the Bank of Russia said that they thought that the average oil price for Russian oil would be $55. They've now revised that downwards to $45. Now, that is $14 less than the assumption in the budget of $59. So that's going to have a devastating impact. If you think about a fall of $14 compared to $59 per barrel, then you're looking at a massive chunk of revenue being taken out of the Russian economy in 2026, which is going to mean a bigger deficit and therefore is going to have to be funded either from the National Wealth Fund, which is almost extinguished, or from gold sales or from debt. So either way, it's weakening the long-term prospects for the Russian economy. But actually, that $45 per barrel also looks ambitious because currently Russia is having to offer bigger and bigger discounts. Talked about it in recent videos that the January results show that Russia is now offering a discount of around $10 per barrel, and that could even widen. So we could see Russia selling its oil. I mean, the recently reported figures I talked about was that it was having to sell its oil for around $30 per barrel, so nowhere near $45. So that could have an even further negative impact on the Russian performance in 2026, which would lead the Bank of Russia to want to cut interest rates further to encourage growth in the economy. But the problem that it's got is that inflation is now rising. And I thought it was worth having a look at this table, which compares interest rates around the world at the moment. So we've got a lot of economies that are really struggling here. Venezuela, current interest rates are sitting at close to 60%. That is off the scale. Turkey, it's 37, Zimbabwe, 35, Argentina, 29, Nigeria, 27. These are all failed economies. These are economies that are completely destroyed at the moment. And if we run down this list, you can see that Russia is here. It's on this list. It's at 15.5. So it's a bit further down than some of the absolute disaster economies. But if you look at who Russia is rubbing shoulders with here, it's got the same interest rate as Ghana. It's got a higher interest rate than Brazil, Congo, Ethiopia, Ukraine. So Ukraine obviously is not an economy that's doing well at the moment, but interest rates are only 15% in Ukraine. They're higher in Russia. And they've got Uzbekistan, Zambia, South Sudan, which is a war-torn economy. So the reason I wanted to put this up is just to highlight how big the problems are in Russia at the moment. It's sitting on a list of economies that are completely failing right now. Now, a lot of people will be sending me messages saying, what are you talking about? Russia's doing really well for all of these reasons. It's not. Its interest rates would not be at 15.5% if the economy was performing well. And if we just finish off by looking at what's going on with inflation, the problem that the Russian central bank has is that despite the fact that it really wants to reduce interest rates, it can't if inflation starts going up again. And realistically, I don't think actual inflation in Russia is running at 6%. It's the official figure that's been released for January. But when you look at the expectations from the people, they think that inflation is likely to be above 13% going forward. And that tells us that prices on the streets are rising more rapidly. So I wanted to make this video really just to talk about this shock decision to reduce interest rates at a time when inflation has started increasing again. It really shows that there are some serious problems going on in the Russian economy right now. GDP has collapsed. The growth in GDP has come from 4% to 1%. It's really struggling right now. I think the tightening of the sanctions is making things significantly worse right now. Russia is really struggling to be able to secure deals with India, who it was selling 2 million barrels of oil per day to recently. So it doesn't have anywhere else to sell that oil. If it can't make any sales, then it will have to cut back on its production, which could have devastating long-term impacts on the Russian oil industry. So there are a lot of problems going on in Russia right now. And I think the fact that interest rates are still sitting at 15.5%, despite the fact that they've just been reduced, tells us that those problems are not going away anytime soon. If you're a business in Russia, you can't borrow money at those levels. It's just prohibitively high. It's going to stop people from taking on debt. Therefore, companies in Russia are not investing back into their facilities, into their people, into expansion. So that means that you start to contract, you get old and decrepit. You can't do things as well as you used to as a company. So the overall summary of today's video is that the fact that interest rates are still at 15.5% tells us that there are long-term problems in the Russian economy that are going to be very difficult to fix. Even if the war in Ukraine finished tomorrow and all of the sanctions were lifted, which is pretty unlikely, the economy is not going to be able to turn around quickly from the current position it's in. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you have liked what I've said, then please give me a thumbs up. If you haven't subscribed already, then please hit that subscribe button. It really helps me with the algorithm. Don't forget, I'm currently running my competition, whereby you can win my property located close to one of the best beaches in the UK, or a cash alternative prize, another way of supporting the channel. Have a look at the QR code on the screen now, or the link in the description below. Thank you so much to everyone that supported me in other ways. If you bought me a coffee, or sent me YouTube super thanks, or signed up as a patron or a member, really appreciate that support. Thank you so much. And here's something to put a smile on your face.